everybody. I'll do a quick introduction of myself and then I'll introduce SI Private Capital for today's webinar, Scaling Success, Unlocking Capital at Key Milestones in Your Business. And I think this is a really important topic, particularly if you're, an existing business looking to grow, or maybe you're just starting out, right? So real quick, my name is Ryan Tagg. I am the sales director of our Tampa location. I've been with Dominion Payroll a little over 6 years now. So if y'all need help with payroll, feel free to reach out to me with questions, and I'll let Richard do a quick introduction of himself with SI Capital.
Hey, good afternoon, everyone. Thanks, Ryan, and thanks everyone for being here and letting us, jump into your afternoon. I'm sure it's busy, and hey, a 2 o'clock conversation a little while after lunch on capital and the forms of capital. What could be more engaging? And so, jokes aside, we'll try and make sure this is really useful. I'll kind of note at the front end of the discussion, we recognize there is a really wide range of knowledge out there on this topic, and very much so may be the case for the folks on this call. We may have a CFO of a company with $10 million in EBITDA and 50 million in revenues, and we may very well have a company that's earlier stage with a couple 100,000 in earlier days of their business. So we will endeavor to make this accessible and useful for everybody. There are materials in here which are a little bit involved within the presentation. It's a leave behind. It's not intended for me to go through every single piece of it. And certainly we'll make ourselves available for questions after the fact. But again, thanks for being here. As Ryan mentioned, I'm with SI Private Capital. I'm a managing partner there, chief investment officer. Our firm, just very briefly, is focused on making investments, either debt or equity, in lower middle market companies across the southeastern United States, across a variety of industries, and which generally have a profile of a couple $1 million in EBITDA up to around $10 million in EBITDA. That aside, my career has spanned being a CFO at banks and investment companies over the last 17 years, investment banking as well as commercial banking. So jumping right in, I thought, one of the really good ways to think about this is, as I mentioned, we're focused on small and mid-sized companies for this discussion. But, the ranges of capital, there's lots of them. And, the scope of discussion, for example, on some of the capital types could go well beyond the hour that we have here. There are college courses that range on some of these capital types, and you could spend a full semester or two. And as I said, we'll try and be brief and useful here. But so we'll leave venture capital for a different discussion, because that's in and of itself, that is startup capital, pre-revenue, early days of business model development. We'll set that aside at this time. And then for companies that are accessing the public markets, by the time you arrive there, you probably have a whole set of resources. And that's another discussion. So what we'll really focus on are for small to mid-sized businesses, privately held. You've gotten some proof statement around your business model and the ability to generate cash flow. Once you get there, you've got access to a range of debt and potentially equity products. And so we'll let today's discussion focus on that. And so hopefully everybody can see this first slide pretty well. As mentioned, these materials will be available to you. And as we lean into a capital discussion, what I wanted to do is, and as mentioned, this will be a recap for some folks, and for others it may be new. But really, let's talk about the capital types and how they fit across the balance sheet. And you'll see this table here. It's a little bit involved, but kind of to lead you through it. On the left-hand side, it sort of profiles the company and the balance sheet. See from left to right, if you read, it's assets, and then you kind of have the debt and the equity side. And if you're reading in the yellow section, there's the various debt types from top to bottom. The traditional senior bank debt, it's secured, it's asset-based. And then you roll down the line next to, say, junior capital or subordinated. And that's in a second position, kind of think of it like your second mortgage if you're less familiar. And different types of collateral, a little higher on the risk profile. And then you get to mezzanine debt, which has a lot of different characteristics that's sort of in between. And you get into what I'll refer to as hybrids, which are in between debt and equity. And then you get into the equity section, right? You've got preferred equity, common equity, and then options, rights, and warrants, and those kinds of things. Um, and what I wanted to first talk about, and it helps frame the discussion as to how do you think about what type of capital you need, how does it best fit your strategy, and what are the ranges of structures and costs and flexibility and so on. And so that sort of first group of considerations you'll see on the right side of the table where it says dynamics and considerations. If you're reading from top to bottom, that middle section, you've got the cost and return. If you're in the most safe and secure type of debt, traditional bank debt, your working capital line of credit or an equipment loan, that's usually your lowest cost of capital and your lowest, you know, risk profile from a lender's perspective, right? And the risk consideration is a pretty important dynamic from understanding what the lender's or investor's point of view is, as well as what the company's point of view is, importantly, right? So as you're thinking about what type of capital do I need going forward, understanding the risks and considerations around that capital type and how they impact your business and flexibility and so on really matter. Um, and so as you look at those three bars to the right, you've got cost and return, lower on debt, as mentioned, higher on equity. You've got risk to the lender and provider as lower on debt, higher on equity. But then conversely, on the borrower side or the company side, it's a little bit higher on debt. And I'll get into thinking about that, how we think about that and talk about that. It's a little bit higher to the company and on the debt side and lower on the equity side. And, perhaps stating the obvious, but as you think through that, as you take on debt, it has a required payment, it has a required coupon, it'll have covenants, it'll have expectations and demands, as well as a priority on the claims of your business and your business activity that's ahead of yours as an owner and equity holder. And therefore, you may want to be thinking about that. Look, that frankly, that's a higher risk profile to you as an owner since all that capital resides in front of you. Taking it to the next section here, again, helping frame as we're the planning discussion. Again, wanted to go through some of the basics and the setup here. I've got a similar set of dynamics for the company on the left-hand side. Again, when you read from left to right, the yellow items apply to the debt component and the blue items apply to the equity. And now thinking about dynamics and considerations, your ownership. If you're thinking about senior bank debt, right, at the top of that stack here, there's no ownership you're giving up. So that's the plus side, right? You don't have dilution. If you can access debt and you're growing your business, number one, it's the lowest cost of capital. Number two, you're not giving up ownership. So it's if you can access it and you profile for it and it doesn't change your risk and flexibility, it's a smart way to capitalize your business and the growing components of your business. As you move down the stack closer to equity, what's going to happen? The ownership component, junior debt, you're generally not giving up any. But as you get into the mezzanine or the hybrids, things like convertible debt or convertible equity, there potentially are some ownership components that go with it. Sometimes they're springing ownership, as in if things don't go correct or as planned, or if things go exceedingly well, there's some ownership bonus to those capital players in the middle of that stack. And the reason would be because they're taking a higher level of risk and therefore they want to participate in what is a higher level of risk or an equity-like risk similar to an owner. So therefore they want to participate in some of the upside. And then as you get into, call it those blue sections down there, the preferred equity and the common equity and the options, those obviously have ownership, alongside with that. And there's a variety of equity types, right? So when I mention preferred equity, what that simply means is it's preferred or its priority is in front of the other equity. And that without, getting too far into the weeds, there's a lot of different ways that can be structured. And I will say for the capital that is on the bottom side of this table, the equity or the mezzanine finance, those are among the most flexible from a structure perspective in allowing a business to grow or grow into those capital components or provide the return at later points in time. They are among the most flexible. And that kind of gets you to that middle section under dynamics and flexibility, or dynamics and consideration. You see flexibility. The debt, as talked about, it has a little less flexibility, right? So the senior debt, you're going to have a debt service covenant coverage requirement typically. You're going to have perhaps a net worth covenant. You perhaps may have some restrictions on distributions to owners. And that's called, those conditions are the price of the low cost of capital. And there are a lot of situations in which that can make sense because you're operating your business that way. And if you've got much more stable, predictable, reliable historical track record of earnings and free cash flow to service that, that can make a lot of sense. As you get into the middle types of capital that we talked about, those junior debts, and then along to the equity side, there's a lot more flexibility in the structure. Mezzanine finance, for example, sometimes it's referred to, if you've heard the term mezzanine debt, or that it'll have a payment structure that's oftentimes very more customized. It doesn't have a straight typical, your mortgage style payment that's a precise X dollars per month. It'll often match the strategy and the game plan, for example, growing a business. And so the performance covenants are a little bit different. And then similarly, as you get down to the equity holders are expecting return in a couple different ways. It's the free cash flow left over after paying taxes, after paying your senior debt, and leaving cash in the business for the future growth and liquidity needs. And what's left over goes to the owners. The equity holders are also expecting that the value of the business over time will increase. And that is among the strategic considerations when you're raising capital, as you're thinking about what types of capital to use. And I'll get into some of that in a moment. As we kind of get to the next section here, right? So you start to, okay, so that's the landscape of capital types. Again, there's lots of versions of what I just discussed or noted, but those are the most basic versions. You go, as noted, from the senior debt to the middle and junior and mezzanine down to the equity, and you've got that cost in your risk profile. And then the next question becomes, what does it take to access those various types? And as you're thinking about your strategic planning and how you're trying to grow your business, for example, are you organically growing your business? Are you making an acquisition? Are you having to reposition the business, meaning, hey, things didn't go exactly as planned and we need a different type of capital to continue on? Or are you setting up for an exit? You want to take some chips off the table, stay involved with the business, fully sell the business. The various capital types that are available are going to facilitate those activities in different ways. So back to how do you access this, right? So I'll start with, again, if you think about it from a lender's perspective, if you're coming in with a lower risk profile and the lowest cost of capital available to the business, you're essentially saying, we don't want the collateral, we don't want the business, we'd just like to get paid back, and with a high degree of certainty, and I'm not going to take as high a return for that. That lender wants predictability. They're going to look at the historical cash flow over the last 2 to 3 years. They're going to think about tertiary ways to get repaid if things don't go as planned, because we all know that occurs, whether that's through a guarantor who's going to personally guarantee the business or the loan, which is very, most of the time in a privately held business. There's going to be potentially collateral. So say, for example, you're expanding your business, you need new equipment, you need a new facility, you're going to backstop those loans with collateral, right? So those things help lower the risk profile and therefore lower the cost. And then as I said, as you kind of move down the stack into the equity types of capital, those things change and they're different. But what's super important to all of them is the ability to have an intelligent approach or an informed approach or an ability to communicate to any of those capital providers what your forward expectations are, right? So on the one hand, the historical, actuals or the historical results tell us stuff that happened in the past, and we've all heard the phrase "the past is indicative of the future," um, but at the same time, it does show a couple things. One, the business model was able to produce these results historically, so there's some reliability to that. Two, and this is super important, the management team and the folks that run the business have been able to produce those results and to do so consistently, right? And so as you look forward on the types of on the capital that you're borrowing from either a lender or equity investor, they're looking to understand with clarity how are they going to get their capital back. And in particular, say for an equity provider and or a mezzanine finance provider or a junior capital provider, they're going to want to really dial into, okay, we're talking about things that haven't occurred before, and we're going to grow a business and we're going to apply more capital, and we're not going to see it until years down the road in some instances. The forecast and budget should be well thought out, right? The assumptions need to be described. They need to be quantifiable. They need to be identifying how did we come up with these numbers? What are the end markets? Who are we going to sell to? How are we going to grow? Versus just a blanket, hey, we're going to grow by 20% next year. It's the why and the how that are super important in those instances. The other components, and this gets into sort of the demonstration of the business model, and that is as you're looking at revenue growth and what kind of profit margins and what kind of free cash flow are available, those are the things that ultimately accrue to the benefit of the equity holders, you as an owner, and also as the potential equity holders that you bring in to be your partners if you're raising equity, and or on mezzanine finance and junior capital and so on down the line. And so ultimately free cash flow are how those folks get their money back and how they get their rate of return. And as I mentioned, in the case of an equity holder, that free cash flow is essentially what drives the valuation of the business. Ultimately, the future cash flows are discounted to present value to say, here's what the business is worth today, and it's the sum of those future cash flows that we can present value today. And ultimately, those become strategic value drivers, as they say, which an equity holder is going to hang their hat on. The other really important components, and this gets into the operational and organizational dynamics, and it's a few things that I hinted on before. But as you're communicating all this information, right? How you run your business every day and your team, and you're the closest person to it. You're going to know it better than anyone else. You're going to know your industry better than most of the capital providers. You're going to know what your daily cash flow is and all those good things. But the ability to communicate those dynamics to the outside investors who are not there day to day becomes really important and drivers of your ability to access the capital, frankly. So, do you have quality financials? Are they produced with regularity? Are they timely? Do you finish your monthly financials or your quarterly financials within 30 days, or is it 90 days, or is it once every 6 months? And while any of those things may be acceptable and useful for you individually, depending upon the situation for your own business, as you get into bringing outside constituents and stakeholders and shareholders into your business, the regularity and the reliability and the quality of the financial information that you produce becomes really important. And so on the one hand, especially for a growing earlier stage business, it's a meaningful investment. You hire a controller, you hire a CFO. They do different things, by the way, right? And teams around them, as well as technology that supports all of that. It's real dollars and real spend, but ultimately, if you can think about it in the context of, all right, if I had X dollars of capital, I could grow my business, this much more, faster, rapidly. I'd have a compounded growth rate that's double what I have today. You start backing into the return on investment. You also start backing into, hey, I've got better knowledge around my business and information that tells me where I'm at sooner rather than later. If you have that information, as a manager owner, you're going to be able to react faster to unintended things that are going on in your business or your industry, and reposition the ship if you need. It'll enable you to more rapidly transition your business to a different product segment, or recognize that margins are changing. The sooner you have that information, the better that information is. It's going to enable you to better run your business. And then, as noted, it really is a high driver of accessing capital. And maybe just a quick note too, and this is probably a little more pertinent for earlier stage businesses. When we say financial statements and quality financial statements, it's inclusive of balance sheets, income statements, statement of cash flows, as well as a statement or position of the owner's equity. And so, understandably, there's probably some folks on the call that do this all day long, and there are probably some folks that, maybe it's uncharted territory and it's a cash-based business. And again, those are all fine things. They're just representative of different stages of the life cycle of various businesses. And so the next component, and again, this becomes critical, is the management and the team that's around the business. And we all know with earlier stage and startup businesses, there's usually an individual or maybe a couple individuals wearing lots of hats. The entrepreneur owner is driving sales. They've got their vendors that they have the relationships with, and oh, by the way, maybe they're doing the accounting too. As you grow the business, the skills that launch the business become different than the skills that begin to grow the business, transition past 5 million in sales, 10 million, 20 million in sales. And you begin to need to surround yourselves with other folks that drive those activities and who have expertise in not only the growth activities that you intend to embark upon, but also perhaps your industry, perhaps their expertise, perhaps the technology that goes around growing the business and getting to the next stage. So as you're accessing capital, particularly equity capital and or junior debt or mezzanine finance, the more riskier types of capital, that management and team around your business and the succession related to it are mission critical to investors, right? Because they're handing over capital but not running the business, and it's the first money lost. And so that's how they think about those risks. And so the more you can either have a game plan for it, again, maybe all the pieces aren't in place, and that's part of the reason you're raising capital. That those are okay reasons, but they'll look to identify the wisdom of the owner and managers of the business to have recognized they have those skill needs along the way. And then, after that, it's also, why are you raising the capital? Have you clearly identified what the capital will be used for, right? And this comes to your strategic planning process. And if you think back to what I was mentioning a moment or two ago, budgets and forecasts, those include the uses of capital. Hey, I'm going to grow the business by 20%, and that's $3 million in revenues next year. Understanding, okay, that's going to be 3 new salespeople, and it's going to be this piece of equipment or that piece of equipment or a building to hold the inventory, and identifying how much that costs, when you're going to deploy those dollars. And then really importantly, and this one gets overlooked with a lot of small to mid-sized businesses, and I think they know it as owners, but it's often not well communicated, and that's the working capital component, right? We all know accounts receivable consume cash. You make a sale, you get paid 60 days later. You buy inventory, it sits on your shelf for 3 months until you convert it to cash. That cash cycle, for every dollar of revenues, how much more working capital do you need? That becomes part of your capital need equation. So if you can clearly identify that component as well in this process, it goes a long way with your capital providers to understand that you've got your arms around your growth plan. And that level of confidence brings confidence to the investor, and it essentially de-risks the situation. So again, clearly identifying, supporting the capital use, and what the risk return trade-offs are. And that becomes sort of the next, and by no means the last component, but I'll kind of tie it all together to say this is part of your strategic planning process, right? I want to take the business from point A to point B. And then the question becomes why, right? I've made these choices because I think they're going to result in growing my business in a way that, doubles my EBITDA and cash flow margin. Well, and oh, by the way, we think that when we do that, the valuation goes from point A to point B because bigger businesses get a higher valuation multiple. Their lower risk profile, the cash flow is more consistent. Equity holders, stakeholders, et cetera, are all better served by that. um, so, as noted, those are by no means, and you see it at sort of the little disclaimer at the bottom of the table there. That's a critical list and probably a really good starting list, depending upon your industry, the stage and life cycle of your business. There are some other components, but this is a pretty good starter. And then last but not least, these are, tying some of that together with your capital planning considerations as you're going through that strategy session. Okay, which capital do I need, right? The first thing we like to look for, and I know when I'm sitting in our chair for our own business is, all right, what are the owner's objectives? What's the timeline for the ownership, right? Are they happy kind of clicking along? We've built the business to a certain level and we're okay, steady Eddie. And by the way, there's nothing wrong with that. Have you identified what the ownership wants to do and the timeline to match the strategy? And then therefore you match the capital, right? Example would be the owner wants to exit in 24 months. Well, would it make sense to take on capital that isn't going to be fully deployed in 24 months, or take on capital with a 10-year life? Or, if you think you can get to the next level to where you need to exit, but it's going to require more than senior debt, because if you use senior debt, it's going to change the risk profile dramatically. Or you as a business owner have no margin for error. You've taken on so much leverage, and as we all know, there are points in time in economic and credit cycles where you can get a lot of credit, right? And it's easy to think about it and go, let me get as much of that as I can because it's the lowest cost. There are some situations where that could make sense, but there's a lot of situations where you've just set your business up to have to sink, as they say, you got to sink every ball on the table for it to go right. And then are you prepared for, if it doesn't go right, the ability to, okay, my senior lender, the working capital line just matured and they used to want to lend us $5 million and at renewal, now they only want to lend us $3 million because the world changed a bit, or our business changed, or we didn't meet the pro forma. And, at those points in time, now you're raising capital under duress. That's a much more costly endeavor than if you've structured your capital to have some margin for error in the outcomes. So the other component is we just talked about a little bit, identifying the resources and resulting capital needs to support those goals, whether it's technological resources, human capital resources, the personnel on your team, the execs, building succession plan, and what other types of physical and or economic resources. And then as you put that together, you then begin to have a picture of, okay, here's what the business profile looks like. Here's the cash flow, the risk profile. And then you can work backward into solving for what's the right capital structure for that strategy and the range of scenarios that could play out. And then you begin to assemble your capital stack. And then from there, you start to say, okay, who are the providers of those capital types? Who would be a good partner, right? So say, for example, you're raising equity. Is it an equity provider that really prefers to see their equity back in 3 to 5 years? Or is it an equity provider with a long-term strategy and they're willing to do a 10-year investment, for example? Or an investment for as long as the business is performing and growing and rate of returns are good and there's a good management team and you can kind of extend on out and be partners for the foreseeable future. And both of those scenarios exist. So determining which capital provider is going to bring that component to the table is really important, as well as if you think about, okay, strategically, I'm really good at this activity and we're going to grow the business and some of this stuff is out of my comfort zone or knowledge zone. What kind of capital provider might bring some knowledge, tools, resources, relationships, industry knowledge, planning knowledge, corporate finance knowledge to the table that can complement what you're trying to accomplish that say you don't already have in-house. When you begin to piece that together, it really creates a good and productive marriage of you, your business, your strategy, and the capital providers. And then, and last but not least, as I probably mentioned a few times along the way, all of that's pointed toward creating more value for you as an owner and a shareholder and with a risk profile that you're comfortable with and where you frankly want to take your business and for a lot of folks, especially in the private business world, your legacy, right? A lot of people think of it that way, and it's good to keep that in mind as you're structuring your capital and game planning. So um, those are the big points. Again, I'm happy to ask or answer questions and get into the weeds or go back and revisit anything that we just went through. But I'll pause there and see if we have any questions.
So Richard, well, first of all, thank you so much. That was extremely informative. We did get one question. It says, what influences the pricing of different types of capital?
Great question. And so this actually comes back to number one, if you're thinking about the debt side of things, what is that historical demonstrated capacity, right? So a lot of bank lenders will look at it and go, okay, your cash flow is $1 million and the debt service is $500,000. There's coverage there. That makes sense. There's a comfort zone in excess of what's required on the debt service. We know they can pay taxes because there's some cash left over. There's room for working capital. And so ultimately, traditional senior bank debt lending with that kind of profile, along with collateral and a personal guarantee, is probably going to be in the, SOFR, which is the overnight rate, which replaced LIBOR plus 275 basis points or 2.75% or 3%. And then on the equity side, the other side of it is all those things we talked about. How well thought out is the forward strategy? Is there a connection and rationalization between history and what is intended to be done going forward? Do they float together pretty well? Is the management team experienced? How have they performed? What do the end markets look like? All of those things that demonstrate a plan that looks like it can be reliably achieved or on an informed basis and the right resources and tools are in place, that's going to de-risk it and bring down that cost. But generally speaking, private equity or an equity-like return for a business with solid cash flow history that gets into the 2 million and up range is, equity is typically in the 20s thereabouts, and venture capital is well north of 30, right? So if you're thinking about how much on the startup side. Now, it's interesting. Sometimes there's sticker shock to those numbers, but I would say the context for those numbers is really important, right? So if you're going to be able to double the size of your business and for example, just roughly speaking, double your EBITDA, right? And yes, on the one hand, you're going to pay what sounds like it's a lot more expensive than debt. And yes, it is, but the risk is different. Again, it's first loss money in a growth strategy, which is a bit more risky. But if, you achieve those things, the valuation is exponentially going to outpace the cost of that equity, right? So it's kind of the old, would you like a smaller piece of a much larger pie versus a large piece of a small pie? And oh, by the way, the larger pie is less risky. you as an owner have probably taken some of your chips off the table and diversified. And so there are, that's probably a little more than the question asked, but I think context is really helpful when thinking about the pricing component. And then I'll add one other additional thought to that, and that is um, price alone is not the way I would evaluate the capital alternatives. The structure is really, really important, right? So debt that doesn't have a guarantee is going to cost different than debt that does have a guarantee. What kind of debt service coverage or financial covenants or financial reporting, or what period, how frequently is the reporting? Does the loan mature sooner rather than later? Did they give you a high advance rate on the collateral or a lower advance rate? All those things um, are really important to weigh in addition to the cost, and or they influence the cost. So hope that was helpful.
Yeah, very, very helpful. One other question. Can you share an example of a company that successfully scaled after securing the right capital at a critical stage, and a bit more about the profile of the company and the capital that it raised?
I can, and it's funny. This just timely reading it somehow came across something that was written. I can give one about Microsoft, right? So Microsoft, and everybody knows the Microsoft story and where they are today. Um, Microsoft had been in existence around 9 or 10 years when they did their IPO, and they had no debt on their balance sheet. They had one outside equity holder. They had been profitable for every single one of those 9 or 10 years that they built their business, right? So arguably, you could say, and I believe they were probably around 100 million in revenues at that point. So it's a good sized business and obviously rapidly growing. But and they were making a lot of cash flows, like almost a 50% margin business. So you could, if you were in Bill Gates' shoes at that time, it's printing money, it's doing well, it's growing fast. For what reason would you go and access the capital markets? Why would you go do an IPO? You're a publicly traded company. You've, you've got to report to a board publicly, all sorts of expense related to it, a whole different managerial exercise, and on and on and on, right? So, and we know how it ended up, right? So Bill Gates raised, I believe they raised around $60 million. They maintained, just over, actually probably decently north of, Bill Gates maintained, I think around 49 or 50-ish%, and the management team, brought it up. So they didn't sell a ton of the company, but the foresight to do that gave them a lot of strategic benefits. One, as they were competing against the other folks they were selling to, they now were, a better known quantity when they're selling their product and wares to much larger companies, right? So they're a publicly traded company. So they're, the financials were of high quality. They were observable. Anybody who was taking a chance at buying their software could, reasonably estimate they'll be around tomorrow. But importantly, the amount of capital, even though it was equity capital and expensive as we just talked about, enabled them to accelerate their sales growth into markets and channels that they otherwise wouldn't have tapped, without just burning all the cash they had on balance sheet as well as their free cash flow. So, it's a pretty extreme example, but hopefully it makes the point pretty well.
No, absolutely. We'll give everybody just couple more minutes for questions. But Richard, mostly just wanted to thank you for coming on. That was fascinating. It's an area where I am not well versed, so it was interesting to learn more about that. And one of my favorite things about working at Dominion Payroll is the connections that you can make, the more you can learn. Our goal here is always to be an advisor, and we certainly don't have the answers to everything. So really appreciate you coming in and just enlightening our clients and helping again. Um, Looks like no more questions, so we'll call it
Okay.
there. Richard, thank you again. This
Yep.
will live on our events page for Dominion Payroll, and
Yep.
then we will follow up with Richard's contact information if that's okay with you, just in case
Absolutely.
anybody has any follow-up questions.
Yeah, sure. Please do. Thanks everyone for taking the time and let me share some thoughts today. And as Ryan, as you send out the deck, our contact information and what our firm is about and where and how we invest is on the last page, along with our contact info. You can reach out to myself or any of our partners who are listed at the bottom of that page.
Great. Thank you so much. Thank you
Yep.
again. And thank you everyone for joining.
Thanks all. See ya.
Bye.